What is going on? Mike and Joe, once again, talking about the market. And this is our second show. So we are going to have some guests coming up, talk about market strategies, what other folks are seeing. Also, going to get an insurance advisor to discuss kind of what we're seeing in California with the changes that we're seeing in insurance that so many people are kind of questioning or concerned of or really have questions pertaining towards. So what I wanted to do is just kind of open this up, Joe, and obviously just kind of chat with you a little bit, talk about things that we're seeing because a lot of things happened in the last week, right?
Yeah.
We saw a lot of changes in the market. So just want to kind of see kind of your thoughts. And I know I share a lot with you, Ben, but yeah, I mean, really, you know, um, we're going to break down everything we're seeing and, obviously talk about things to come. But what are your thoughts about what we're seeing right now in the market after February? And yeah, want to just open it up to you and just open banter if you
Yeah, no, I'm definitely, just monitoring market like I'm monitoring NFL free agency right now.
will.
But yeah, so it's definitely been interesting. Kind of seeing some similarities between the fall when we saw that little bit of improvements in,
Yeah,
mid-September.
yeah,
But I think what was great this time is we're kind of knew what to expect this time and prepared for that ahead of time.
right.
Because as we're seeing, it's a very short-lived thing. You get a very short window where those rates do improve,
Yeah,
and then they go back to normal. And if most of the conversations I'm having with people, it's like, when are rates improving? When are rates improving? And it's
yeah,
it's really just about, and that's it's perfect why we have the strike rate system in place
right.
because you have such a short time frame. So the biggest thing is just basically being prepared,
Yeah,
having everything all ready to go, and that way when things do improve, you're all set and you can go ahead and strike when the time's right.
100%. It's about being ready, right? We locked and
Exactly.
loaded, so to speak. So, I mean, on that note, I do want to share just a slide that kind of unpacks this a little bit. And then let me move this out of the way. Sorry, guys. Um, oh, geez. Here we go. All right. So these are projections that we had, and this is as of February. Now, these projections, candidly, a lot of people don't know this, were actually lower third, fourth quarter last year. But as Joe mentioned, we did have a couple of blips of improvement and signs of improvement. Now, keep in mind, things that will improve interest rates, for the most part, is not the Fed rate. The Fed rate does help a little bit because, of course, it's the overnight borrowing rate, meaning that's what banks kind of use to borrow money. It does affect credit cards, home equity lines of credit, your APY and your basic savings account, some CD accounts. However, when you look at actual inflationary figures, that's really the larger impact to what we're seeing with interest rates. Now, of course, the Federal Reserve will lower their federal rate depending on the strength of the economy and what they're seeing in these markets. Now, the reason why I bring this up is, as Joe mentioned, in for like 3 or 4 days, I think, in August, and maybe 5 days in September, we had interest rates drop. In fact, we locked in a couple of transactions, conventional transactions, around 5.5 to 5.75. We had FHA, VA in that range as well, a little bit lower even in some cases. And then it went back up. And the reason why is we did see still concerns with inflation, announcements by the Federal Reserve that concern that. We did have jobs reports. I remember one weekend well that came out right before the weekend, and the weekend really brought a rally of what we call a bear market in interest rates. Keep in mind bulls and bears in the market. A market goes back to when a bear is like "Rawr," and starting to growl and push things down. A bull market, horns up, is pushing things up, right? But this is what we call a bear market for interest rates because interest rates actually got worse. And it was because of those jobs numbers. And then, of course, we had a couple of difficult months thereafter where interest rates continue to rise. However, in the last week or so, or 2 weeks now, it was about 2 weeks, right, Joe?
Yeah,
Uh,
it's been about 2 weeks. Yep.
yeah, so we had interest rates through the weekend. It was because our new Treasury Secretary made remarks saying, we're very conscientious of number one, where inflation is, number two, where the bonds are trading and shifting, number three, how that performs with things like real estate, because believe it or not, real estate, is, at least in the state of California, is 30 to 40% traditionally of our economy. That's a huge, huge market for California. And a lot of the nations like that. 20 to 30% is driven by what happens in the real estate market. So those are huge things, which caused, of course, things to improve for, again, about a week. Now they're starting to trickle up again. And so what we're seeing now is, according to this kind of this mortgage rate projection chart, if you look at Fannie Mae, the Mortgage Bankers Association, Wells Fargo, and the average of all three, you're starting to see Q1, 6.97%, minus that 1 week where we got back down to about six and a quarter or so, right? And then FHA transactions, even in VA or government loans, a little bit better than that. Q2 should improve a little bit more. Q3, a little bit more, and Q4. Now, these are averages, meaning this is a span of time. What we will continue to see is blips in the market. And people really, I hope, will kind of understand that the rate that you see advertised, if you get marketing material, if you get these emails from items, or I would say from your lender, or things in the mail, of course, postcards, we all get them. I've gotten about five or six in the last 8 days. It's funny. That's when that's printed. That's not saying it's still consistent, because these markets really do, as we've seen in the last 3 years, move on a dime, right? So inflation can impact that. Now, if the inflationary figure that we have comes in at 3, rates aren't going to really change. In fact, they may get a little bit worse. If they're 2.8, 2.9 or better, we could see interest rates improve a little bit. However, keep in mind, again, this volatility with the concerns we have with tariffs. We have, of course, the federal decisions with that rate, right? Those items can shift things because it shows uncertainty in the market, and of course uncertainty with the treasury markets. So if you're on the fence, this might be your window. And if you have a lender that you already work with, great. I would connect with them. If not, we want to help you. We're here to help. We have a strike rate system set up. We do a full analysis to unpack what things actually look like for you. And at that point, we have a strike rate set as to where, if it hits that strike rate, we start monitoring it really closely. And then as soon as there's an alert to lock, meaning rates are going to go the other direction, we then take advantage of your opportunity for you. So you get the lowest possible thing that we could get you in that span of time. But it has helped. I think, gosh, Joe, I think we were able to lock up about 12 or 13 transactions just from that alone, right?
Yeah, no, you're correct. Yeah, about
So
12 or 13.
yeah, we got 12 or 13 folks that are doing well as a result of that. And I think, it's a big concern with buyers too. I mean, Joe, we're seeing buyers right now that are kind of stepping out of the market. They have concerns about what's going on with interest rates and things too. I know you and I kind of work with that very closely, but I guess what are some of the comments or things that you've seen or heard of, to kind of see what your thoughts are? I know you deal on the front line with me more often than not. So what are you seeing with that?
Yeah, and this is one of the more unique times in my short career in the mortgage industry. I'm not used to seeing this much inactivity, and in the sense of that we're getting clients sometimes who are in the market
Yeah,
and then just jumping ship, with the news that's been coming out as of late. So a lot of it is just the uncertainty of everything.
yeah,
Everybody is kind of conscientious of everything going on with the current administration, and maybe not having a full understanding of the direct effects with some of these new economic policies that are being instituted.
right.
And that's, I'm still kind of trying to keep up as we go along too, because it is a lot, you know what I mean?
Yeah.
And I don't think it's necessarily, as we're kind of seeing, very direct correlations once they are enacted. Everything's just kind of up in the air at the moment. So
Yeah.
I think that's the biggest thing from clients at this time, is just the uncertainty of everything, not knowing, and then also just kind of having the hope too that housing prices are going to come down and rates are going to come down. That's always the biggest one.
Yeah.
People are kind of just want to wait until things improve. And sometimes that's just not the case. And it's kind of
Right.
like you said, if you're on the fence, this could kind of be a window, because ultimately there's less competition in the market.
Yeah.
It's almost like with this industry, it's kind of like opposite day. You know what I mean?
Right. Right.
When things are bad, potentially that could be an opportunity for you.
And I think a lot of folks don't understand that in a market like this, interest rates higher. The idea that we always have with any one of our clients is it's great to find out how high you could be approved for. High five, great to know. Excellent, party on, Joe.
Party
But
on, Garth.
yeah, buddy. But the fun thing there, or that was a fun thing to say, should I say, but is to realize that if you're okay with the payment, that's what matters. Not how high you could go, but what
Yeah.
fits your budget. I'm a big budget guy. I'm a big advocate for Dave Ramsey's Financial Peace University. I'm a big person that would look at your budget overall and make sure that you don't live on ready packs of salad and top ramen after you acquire that property, or have an emergency fund set up. You need to have 6 months, ideally, for basic repairs and upkeep to the property. The second thing is, of course, Lord forbid something were to happen to the individual that just purchased the home. You want to make sure that you're able to carry things for a few months till you kind of get things squared away, back on your feet, if you will, right? And I'm a huge advocate for that. So we like to go through the whole wealth breakdown. And speaking of that, of course, this is the next graph I want to share on this show today was if you look at really this one, percentage home prices. This is a big concern. Again, this affects affordability. And this is, I think, why a lot of people are feeling this stress, affordability stress. We have rate jumps, economic fear with the tariffs and job market worries, as you had mentioned. And then, of course, we're starting to see, gosh, I think last month I was speaking to an agent, and the statistic is interesting, but it's the highest number of cancellations in any given month in our
Wow.
industry. It was last month in February. 29% of buyers apparently had canceled escrows. And I think the concern is affordability. So the idea here is being realistic with your approach, knowing those numbers, being comfortable with it, understanding the swings. But again, understanding our first point was understanding that if rates improve, you have a strike rate set up. If you work with us at least, and I know most other banks and lenders, our competitors will do this to make sure that you're secured. But here's the big thing, right? And this is a big picture. Percent of change in home prices over the last 5 years. This is according to Q4 2024, so last year. National average, 57.1%. That's actually a really big number. A lot of people really kind of understand or digest that number, but that's because of course, things like the supply, the lack of supply that we have to meet the demand. We're actually, uh, candidly, we're off by about 4 million homes to meet the supply of housing that we need in this country, which simply means that if we have not enough homes to meet that demand, home prices will continue to rise. And as they rise, of course, there's more pressure on affordability. Now, if interest rates stay the same, that's an effect. It means appreciation can slow. However, if you look at the state of California, the last 40 years, the average uh, appreciation rate is 6 to 8%. Recently, we've seen 10 to 12%. Even if that slows down, there's still, of course, affordability in that market, which, of course, now I'll stop after this and kind of open it up again. But we have this other graph which shows December as a forecast of again Q4. This is the second slide showing how much appreciation we're showing and expecting throughout the nation. California is going to be a little bit tighter because it's a larger um, area, or should I say, a larger population and an area, especially those metropolitan areas that continue to appreciate. So in 2005, they're expecting nationwide 3.7. California is probably closer to 8, 9%, maybe off from the 10 to 12%. 2006 or 26, pardon, will probably be likely the same and so forth. So what does that mean? If you purchase a property today, yeah, you may be able to get that higher rate, or you may get the higher rate. Know that you can refinance to get that lower rate. However, affordability, because of the demand for housing and the lack of housing that we have in this country, means that affordability continue to appreciate or to continue to be a little bit difficult there. And it's really just the best time to buy. And everybody asks this, but the best time to buy is truly when you're ready. But knowing these markets are happening and making sure that you're set up for success to purchase in a property that you're happy with, that will be long term, that you could find affordable and do so hopefully before things get too far out of hand. So that was gosh, some thoughts there, I guess, Joe, for you on that. I mean, is there anything that you're thinking as you look at those graphs?
Yeah, and I'll kind of just relate it to anybody who's looking at homes. If you're like me, when I first started looking for my home, you go to Zillow, you go to Redfin, and you can kind of just look at the history of how, houses that have been, the last time maybe they sold, and be
Yeah.
like, wow, if I just bought this house back in 2020, I would have paid a fraction of the cost.
Yeah, man.
And it just kind of really relates to the home appreciation that we do see for the value of homes.
100%.
I know you mentioned that the best time to buy is when, you're comfortable to buy, but I would also just second that and say the best time to buy is always now, as long as you're comfortable with it. You know what I
100%.
mean? Never
100%.
really obviously, as long as it's within your level of comfortability,
Yeah.
you know, don't let price be a factor in prohibiting you, because
Yeah.
most likely with what we see in trends, it's going to appreciate in value. And then who knows, in the future, when you go to sell your house, someone could be looking at it saying, wow, they bought this house for set amount at this time period, and now it's selling for this time at this set amount,
Yeah.
this increased
100%.
amount.
Yeah, I mean that's a big one there, and not a lot of folks understand. A lot of people are also waiting to see for down payment assistance. They may not be able to
Yeah,
qualify for the program because down payment assistance, most of these programs require, at least a 640, 660 credit score.
660.
Um,
Yep.
yeah, and that's why I also want to kind of bring up the fact that we did bring out a new program that allows for it down to a 580 credit score, and there are some community investment programs as well, right? So that could go to a 580. credit score for a lot of folks and help them. And so what, as we say that, we understand that, of course, appreciation is still happening despite the headlines that you're seeing in the market. Um, there are down payment assistance programs available. If you start to see a property is listed for more than 30 days, there may be an opportunity to actually renegotiate that price with the seller. However, more properties, if they come and they're hot, they're staged, ready to go, you're still going to get. I mean, I saw one last week in San Francisco, 15 offers on a single property. It was listed at 1.5 and it went well over 2.2 million.
Wow.
And it was one of the ones that we actually made an offer on, Joe, and we missed out, even though we were
Ah,
a 14-day non-contingent close. And that's one of the ones again we're getting fully underwritten, which is another way that we're helping with that. And as you know, full underwrite is a great way to help win a transaction, right?
oh, absolutely. We've had a lot of success with that. And that's something that we've been doing for years now.
Mm,
And it just kind of goes back to, being prepared,
yeah, yeah,
Um, we have clients who we have a short relationship with in the sense that like they kind of get introduced to us and they're looking to get in the offer or get into the market immediately. And
yeah,
then we have our long-term clients who have been in the market for years and maybe it's their first house, maybe it's their second house, third house, whatever it might be.
yeah,
But yeah, definitely getting fully approved ahead of time. One, I think it's going to make you more confident in your offer because you've already had your file reviewed by underwriting.
right,
So it kind of just gives it that, that stamp of approval.
right,
And that way you're also, just being able to put in a more competitive offer.
yeah,
It's like you've always said too, it's almost like as good as a cash offer, if you will.
yeah,
Just knowing that that financing is going to be able to be secured on
yeah.
a purchase.
Yeah,
So
and I think that's huge. I mean, and that's a great way to win. And a lot of people don't understand. So I'm gonna try to find this graph right now, if I may. But there's actually a graph to show, and I did a presentation on this in 2020 because there was a lot of concerns about the markets could collapse because of COVID and all that. And of course, we know
mm,
the history. We just showed that graph after the last 5 years because believe it or not, this is I think this is it the anniversary of the
this
shelter in
March, yeah.
place.
Wow. I think it was just
So
yesterday, right?
I know, is that crazy, right?
Yeah,
So
it's five
that's
years later. Wow.
yeah, this is actually in a presentation I give to most of my buyers when they get pre-approved, candidly. But let me share this one slide with us. But yeah, 5 years and home prices went through the roof. I consider myself and Jacqueline, my wife, incredibly blessed to have purchased when we do, because I mean, our property has actually more than doubled since we acquired it, which is
That's
incredible.
awesome.
Yeah, we bought it off market. And Joe, same with you. You guys did after the whole shelter in place and COVID.
Right.
However, the property that you ended up buying, I keep telling people, it's like, man, he did so well. It's so cool to tell that story, almost as a testimony of why I think buying in this market may make sense for a
Yeah.
lot of folks, right? But let me see. Can you guys see this screen, by the way?
Yeah, I can see it on there, dude.
All right, so housing prices have gone up in the last 6 recessions. And this is a thing I like to actually share quite often. This is from the Federal Housing Finance Agency. Now, we see 1980, this kind of went up. We had another little blip here with the savings and loan crisis and ended 91, 92. We did have a bit of a recession there. That was during Desert Storm. And then, of course, we had the dot-com boom, and boom. I mean, it went up and then it came down. And we experienced that a lot in, of course, San Francisco, where I am. And of course, we did see the financial recession or the Great Recession, which is driven by housing and that market back then in late 2008, 2009. However, we did see the slump. We started to see multiple offers after that slump. I know because that's when I bought my first property right here in 2010. That property, 47 offers on it. And
Wow.
we wrote an offer saying we're non-contingent, could close in 10 days. It's a company back then that we could close in 5 days legally. Now we can't do that because of disclosure packages, because of how Dodd-Frank changed that, updated it with the Mortgage Disclosure Act, which came thereafter. But yeah, we closed this thing in 10 days. And then I still have that property, by the way, and it is a rental. So again, a great opportunity to purchase because if you look at this upswing, just look at this little slowness here, and that was COVID, right? But then just up and up and up. And again, why? Each of these decades, just to let you know, they were building quite a few more properties. I'll find the graph maybe for another show that we do with a market update, but they're building a certain number of properties that would actually be a little bit more than what was required with housing starts or what would meet the housing start number, which is why properties were kind of steadily appreciating throughout this time. Now it's continued through about 2000. And then we started to see a huge number of houses get built really quickly. But after this, it became difficult to build or concern in the market for building new properties and new developments, and of course, running out of space in certain metropolitan areas. So, with that number, of course, we have about 11 million properties, resale, and new construction available in this country, countrywide, with a housing start number, meaning new families looking to purchase a property of 14 to 15 million. As we see that, of course, that's basic economic supply and demand. This is why we see these peaks, even with COVID, those peaks. And you can see how it arches so much more here towards the tail end where we are now. That's why we're expecting to see continued appreciation. So the idea, as we mentioned, it's better to at least get started, know what things look like, get comfortable if you're looking to purchase a property, and at least try to figure out what's going to make sense and what's not going to make sense for you, right? So those are important things, I think. Now, on that number, of course, the big thing that I want to bring back to is, kind of that silver lining, if you will, is staying balanced, right? I mean, we know that there are a lot of programs are available to help first-time home buyers. There's appreciation still happening. There are more listings on the market, so that means there's a little bit more opportunity for buyers. But I think staying optimistic is increasingly important, despite what nationwide we saw last month and what we're seeing. And I think really, Joe, that's kind of where we find that peace, right? Just taking time to just enjoy where you are, knowing that it is a market. This is real estate. This is mortgage. Things
Right.
will continuously change.
Yeah, no, and we saw this back in 2022. We were just coming out of, the boom from COVID. We
Yeah.
were seeing a lot of new purchases, refinances, and then things did tail off a little bit when rates started to go back up. And then eventually it kind of came the norm. And then everybody started returning to the market, and we kind of saw things kind of stabilize for a little bit. And perhaps we're at that next, blip where things have kind of slowed down for a little bit. And
Yeah.
then I would assume that eventually, as people kind of settle in, we'll kind of start to see this stabilize for a little bit. Hopefully, things improve. But,
Yeah.
I think as people realize that this could be where things are at for the foreseeable future, hopefully just short term, but could see people get back into the market, I think. Yeah.
Absolutely. So, two bullet points to wrap up here. I'll go first. If you're an agent, if you're working with us, we call you every Monday. You know that, to check and say hi, see how things are going. But if you're an agent that doesn't work with us, we're here. But candidly, if you have an agent you have a relationship with, love that agent. I get it. We have those relationships as well. Stay close to your lender. This is a market for teamwork. Teamwork makes a dream work. I'd recommend that really to anybody in this market, and continue to just nurture that relationship. Find ideas, find those opportunities. They're certainly out there. And I think there's a lot of opportunities for buyers in this market as we start the spring market, because as we do see again, these blips, this can pique more interest. If people find out interest rates are at 6%, I mentioned this, I think, in our last episode, it's like
Yep.
green light or red light, green light. Red light, stop at 7 above. You start to see less people in the market. 6%, you see this rush of people into the market, and ends up being incredibly crazy. Already with the spring market, we're starting to see multiple offers as we've seen this week. So that being said, market, speak frequently with your partner, agent, lenders, realtors. Do the same thing. Speak with your lender often. Keep that dialogue going. What's going on? Get updates. Also, feel free to follow us on social media. We do a lot of updates through our social media platforms. You can find me at mike.belfour on Instagram. I believe it's the same handle on LinkedIn and Facebook. So we're certainly here. Joe, your last bullet point.
Yeah, no, I would just say the best thing to keep in mind is just to be optimistic going forward. Um, Things will improve. It's just a matter of when, and in the meantime, just think of it as an opportunity.
Yeah, yeah, exactly. Rates are moving and the opportunities are out there if you're ready, right? So next time we're gonna have an insurance guy talking about the market, someone who's a good friend of mine. Finally, Trevor, we're gonna get him and we're gonna do a show with him and kind of unpack what we're seeing with the changes, especially here in California. There's a lot of concerns going on with Cal Fair Plan. There's concerns with insurable properties, spikes in insurance companies leaving the market. Those items we're going to discuss. And yeah, definitely looking forward to that show. Joe, anything before you head out?
Yeah, no, I'm definitely excited for that podcast as well. I think there's going to be a lot of good knowledge in there and very relevant information. So,
I'm
yeah, definitely. Looking forward to the next podcast. And yeah, like Mike said, if you guys need anything, just feel free to, think of your lender as a resource. So
Yeah,
that's
yeah,
what we're here for.
absolutely. All right, we're signing off. Until next time.